Welcome to The Other Side of the Table with me, Tom Frogger. Raising money in biotech, tech bio and life sciences is crucial and complicated. In this podcast, we'll sit down with specialist investors to understand how they see the market, how they assess potential deals, and the mistakes they see time and again that you can avoid. On the other side of the table today, I'm with the always insightful Darrin Disley, founding CEO of Horizon Discovery, current Chief Exec of Mogrify, and investor in more than 40 life sciences and social enterprise businesses. We get into why angel investors have different motivations, the importance of vision, why cap structure is absolutely critical, and much, much more. Stay with us. Joining me this time on the other side of the table is Darrin Disley. Darrin, welcome to the show. Good to see you again.
Hi there, Tom. Nice to see you again.
I'm really excited to get into today's conversation with you, Darrin, because, of course, as I said in the introduction, you are a multiple entrepreneur in biotech and in other sectors, invested in 40-odd companies now. Is it
about that? Yeah.
Yeah.
For better or worse.
Lots of boards. So you've seen the market as it has been and as it is from both sides of the negotiating table, and so really excited to talk to you today. We are recording this. It'll go out in a few weeks, but we're recording this right at the end of January 24. As we always do, it'd be great to start with your views on, particularly in biotech, where the market's at and what people are seeing out there.
Yep, I'm going to try and strike the balance between being realistic and put it into context of the other times it's been difficult in the 30 years I've been involved in biotech, but also be optimistic about the opportunities that still exist for companies, right? So if we look at the 30 years I've been in the industry, those who can remember in the 90s was where it was massive recessions, 15% interest rates, inflation in well into double digits, significantly worse than it is right now, right? It was really an emerging biotech sector was really struggling, full stop, to come out of that. But out of that wave, downturns really sort of hone people who want to do this around there, and they really, like-minded finders come together with a great idea that could disrupt. The great science is still the great science. The opportunity back then, as the biotech was emerging, was still massive. People barely understood genes, let alone translation into proteins and functions of cells and various things like this. So the opportunities for fledgling companies like Genentech, Biogen, Amgen, etc., which all started sort of in that sort of a 90s period, were there, right? And those companies obviously went on to become massively successful out of a really bad time. In my own experience, 2008, the financial crisis, no one would think that the worst recession in 100 years is the best time to start a biotech, but that's when we decided to start Horizon, right, in terms of the commercial phase of Horizon. And there'll be things that I think are common to those companies that make it from those tough times, which I'll touch on in some of your other questions later on. But just put into perspective that terrible markets still represent opportunities. Great science is great science, great people committed, aligned to each other to a common vision and purpose is still there. But some more practical things tend to have to happen in terms of what is our plan, how are we going to deliver it in this sector, how is our business model disruptive, etc. You perhaps can't have as much largesse in your business plan, business model as you would have in good times. But if we look at the market, because it's the worst that I've seen in my 30 years in the industry. And if you look at why this is so, it started post what I call the fake biotech boom during the COVID-19 pandemic, where vast amounts of hedge fund money, one could call it smart, one could call it dumb, but it was smart in the sense of speculating that everyone was going to be navel gazing about their own health and healthcare in general in 2020, 2021. And you ended up with a massive overvaluation of biotech stocks around there. And so you had a boom, the record highs on the NASDAQ, etc. And when people use that to raise vast amounts of money, so you ended up with lots of money, lots of new VC funds were raised. There was just vast amounts of capital around. But that's led to the first problem, which is a massive overcapitalization, overvaluation of the sector. So what happened when the reality kicked in? We're going to be coming out of COVID in Q4 2021, at least the first early stages of that. You had a big outflow of that capital, and you ended up with a collapse in biotech valuations. Initially 40 to 60% revaluation based on that money moving. And then as is always the case, those who don't have money are the ones who lose the most money. People with their pension funds and their 401ks in the United States suddenly start panicking because they need to crystallize out their pensions in a few years. You end up with a further collapse, a second sort of dip, if you like, in valuations. So things are down 50 to 90% in terms of valuations. You've got over 300 companies who are trading at valuations that are less than the cash they have in the bank, if you think of that as a concept. And that took a little while, but it started flowing through to private companies, because ultimately private companies have to refinance, and refinancing is a step towards either an exit event, direct exit event, or going onto the capital market. So the question comes, who's going to pay for that next price uplift in the private company? So you've now had a collapse in private company valuations, and on average in 2023, valuations were down sort of 40% in private companies around there. So you're seeing that sort of now follow through of that. And this overcapitalization really compounds that problem, right? So you've got companies, and I've raised significant money over the last few years as well. If your company's got too much capital and its valuation is too high, yet the person you're passing the valuation chit onto, if you like, at the next step is seeing their prices absolutely shrink, and the opportunity to go to public markets to significantly reduced, they want to in fact reduce the valuation and reduce the risk around there. So what you've seen is people making tough decisions to reduce the scope of their business on the public markets and private markets. A lot of the CAR-T companies have reduced the number of programs around there, so they've reduced their costs. So whilst they raise a lot of cash, they're preserving that cash by reducing the number of programs, and then that comes with commensurate job losses. And you've seen this all the way across the sector. Even stars like CRISPR Therapeutics, Editas, Intellia, Precision Biosciences, all of these kinds of companies on the public markets have started laying people off, and it's happening in the private companies as well. So preservation of cash and making sure you can deliver some milestones in a narrow sort of portfolio. So you'll have read the flat rounds are the new up rounds around there. If you can raise a flat round right now, you're doing well, but typically you're having to take some reduction. But there are some potential positives, right? If you're starting a new company right now, where you either got a very entrepreneurial company, you've got a short-term product or service offering, and you can turn your intellectual property and effort to cash quicker in a practical business model, those businesses they're always in vogue around there. In fact, when times are really tough, they are very much attractive. So that would have been Horizon in 2008, 2009, where it wasn't losing money, it was breaking even and growing fast because it had products and services to sell. So you become a biotech that doesn't need lots of money around there. So there's opportunities for companies like that, as there always is in these tough times. And second, if you are, a lot of VC funds raise new funds, and they capitalize their funds a lot more during that period of the pandemic and post-pandemic, whilst being a bit conservative in the subsequent years. They have to deploy those funds around there. So those funds need to be deployed. And I think what's adjusting is the ratio of money they invest in existing companies that may be overcapitalized versus companies they get involved with at the ground up and help work with the founders to guide the companies for company creation. Those opportunities are very much still around, and may be preferable in some sense, because the VCs are not trying to reshape a business and set expectations of a founder. They're working with them to come out with a more narrow proof of concept around a therapeutic, for example, or a platform, and they can shape that business as they go along. So those opportunities are still there. The biggest challenge are in companies that already exist, that have already raised significant capital at valuations that haven't been rebased. So that's where the biggest challenge is.
Yeah, absolutely. And I think, it's you mentioned some of the companies that sort of were forged in the prior recessions, and I guess there's an element of, if you're going to build something that has a lasting impact, that is a success story, there's going to be times where it's incredibly challenging, right? And this is that time for a lot of companies, I guess.
Yep. I mean, it's definitely what's also happened in a lot of these past recessions is there's been a shift of risk appetite from platforms. So things where your platform could address multiple therapeutic indications, multiple modalities of therapeutics, or platform technology that could derive products and services and could be leveraged also into the value chain of the therapeutic. There's been a shift away from that kind of risk appetite, and people have moved into more, well, show me the product. You may have a platform, but show us the first product, and let's deliver the validation both technically and in terms of market from the first product, and then we'll give you some value for there. So you see the problem, right? Those who've already raised the value based on the potential of the platform, we've shifted the product, have the problem with the platform valuation around there. Platforms can be valued higher earlier because you turn them to cash typically much quicker around there, and products get started lower value in terms of your therapeutic, but the escalation in value is dramatic. So there's a bit of a mismatch, right? So this shift from platform to product is causing a problem for platform companies around there. But that doesn't mean you shouldn't do it right around there. I think there is some green shoots coming, in that people now, they've gone through this really tough time. Platforms have always done very well, right? And ultimately, if you can prove that you can develop the product in one, and then you can address products in lots of different disease indications, lots of different market sectors, etc., that is more scalable as an opportunity. But I think people who start those companies, platform companies, or manage those companies, need to be much more practical about the size of the first chunk they bite off in terms of validation of the platform, and then looking to scale. This is the point I mean about being realistic when you set your company up. You may be able to do X, Y, and Z with your platform, but you need to initially focus on, well, let's prove it can do Y, and we still have X and Z in our pocket, when we get to that stage, and that shows the potential to continue. We're not a one-trick pony. You're not going to have to sell us for the one asset. We could actually build a company that has longevity.
And I suppose it's important to realize as well that prove it is a relative term, right?
Yes, and the burden of proof has got higher, right? So, for example, in therapeutics now, the traditional. So, if you're in obviously in a lot of cell therapy and gene therapy companies, there's been a definite shift to clinic. So I chair a company that's in the clinical stage, and that's getting much more traction because whilst you need a certain amount of capital to do a phase 2 trial, and it's a pretty binary risk, that if you succeed, you're going to have a massive value inflection, right? And if you fail, well, that's it. You're not going to need any more cash. Whereas if you're a very early company with a platform and you can do 10 different things, and your first proof doesn't work out, but that could just be that one. That could just be Y. Actually, X and Z will be fine. We need more cash, right? So to get value out of it, you need to keep adding cash. So there's been a shift to later stage. And then even in the earlier stage, in the preclinical phase, the bar is definitely being moved, because it can be right now. We may not like it as entrepreneurs and people, that you set your stall out that we're going to get a proof of concept, say, for example, proof of cell conversion in a cell therapy around there, and then we might understand something about mechanism. Well, they can start saying now, okay, well, that would normally be, say, a Series B valuation, but we'd actually like to see some extra safety data. Or we'd like to see a more well-positioned around the intellectual property, as in the bar just keeps moving. And that presents some real difficulties, obviously, because you're funded in 2-year cycles, and you're expecting to get to these milestones, and they're shifting the milestones a little bit further out.
Yeah, absolutely. And this probably leads on to my next question, really. You obviously will have an opinion on this as an entrepreneur and as a leader of a company, but as an investor, how has the market as it is now affected what you look for in an investment, and what are the kind of key things for you that you judge an investment on?
Yep, I think it's slightly different for an individual. An individual, an angel, an investor, for want of a better word, than it is from an institutional fund. The responsibilities, accountabilities are very different. My accountability is to myself. Around there in terms of making that investment, whereas an institution is managing someone else's money, and they'll actually be in a regulated environment. And let's be honest, not everyone who runs a venture capital fund actually has experience of starting. Their appetite for risk reward is different from someone who starts a company and has done that, versus someone who observes, participates, engages, so they know how a company is built and how you create value from capital invested, but they don't necessarily have the risk appetite of someone who's starting the company, right? My appetite for risk is very different to someone who's managing a VC fund, typically. Not always around that, right? But when I look at it, it's somewhat different, right? So there's two types of situations that I'm looking at, and this is very sort of entrepreneur angel, right? Maybe specific to certain types of entrepreneurs. Is I love disruptive platforms. So I don't get out of bed anymore to make widget X that might improve someone's life by 2% around there by selling X number of units of it. I like understanding complex things. I think the world's problems moving forward, the scalability of our systems, our sustainability systems, so energy, for example, food, etc., our healthcare system, how we, what is the healthcare composition going to be in a chronically aging population? The model clearly isn't. So I look for things that, how are we going to solve these complex problems?
Yes.
So I'm interested in disruptive platforms that don't necessarily have a short-term market. They may even be ahead of the curve in terms of you don't know yet. Most of the things, when you think about some of the great success stories, the arms, the autonomies, the abcams, even the horizons to a certain degree, they were ahead of the market. People didn't see what was possible. They didn't see quite yet the problem. They may have understood the problem was mostly there, but how you were going to solve it in a way that was truly disruptive and not incremental around there. So I'm kind of interested in those because it's intellectually interesting. It's very, it's something to get out of bed in the morning. You're going to make, if you build it and they come, you're going to make a major difference around this. So I look for the medium and long-term market opportunities from a disruptive platform. That's one type. Or the other type of investment I look for is where someone's got something very specific in there. There's a short-term market opportunity that's well defined, and you've got a product or service that is well positioned in that market. And preferably your competition is a slow-moving incumbent who can't be as nimble as you in terms of how you're going to address and disrupt the market. And then you've got a group of founders that are really quite savvy in terms of how we're going to do things that these big companies can't, and maybe that's informed by what we did at Horizon, where all the players were all the competitors were major players like Sigma Aldrich. Around there, we ended up buying a division, Sage Labs there. Dharmacon was a division of GE Healthcare, and and we could do things that those big companies just couldn't, and it didn't move the bar for them, for these relatively small to them operations growing at a certain percentage, but make a big difference to us around there. So I look for things, if it's a short-term opportunity, that it's very disruptive founders with business model and preferably a slow-moving incumbent. So they're the two types of opportunities I look at. But when I look at the next thing, which is people, because I think businesses don't typically fail because of market opportunities. You can not define them well, you can slightly miss them, you might need to pivot in them, etc. They don't, in my experience, fail hardcore because of technology. Maybe drugs are different. They fail in phase 2, phase 3 as part of the process, right? But it doesn't normally fail because of fundamental laws of physics and things like this, right? And really good people will take a second tier technology and they can pivot it into a market very well, or they will solve a problem around a technology problem, and you might get delayed a little bit, but so it doesn't normally catastrophically fail because of technology. What it does catastrophically fail of most of the times is people. And it really comes down, to alignments. Leadership is about aligning a complex group of stakeholders to a common purpose. Well, when you're in a business, you've got to align founders. You, Tom, might want to cure cancer. I might be interested in curing cancer, but I want to make $10 million as well. Well, that's perfectly feasible if we come to an alignment on how we create a plan that can achieve both of those things around there. Whereas if we don't talk about it because you're the scientist, I need you to be great at science, and so I hoodwink you, or I'm not honest with you about what my motives are. You're starting with poor alignments. And if you start building strategy execution plans on top of that around there, and then you have really poor governance, you're not communicating effectively with stakeholders, when you inevitably have to change course, for example, around there, how do you bring people along if they're not been aligned to the journey, right? So I think about alignment of people is really important. So that's particularly founders. I like simple cap structures. If I see another cap structure with the Three Musketeers, where everyone's got a third of the company already, even though one of the founders that's got a third did 10 years of science and is totally essential, and someone else is an MBA student who's done about 3 months of work and has got a third of the company because they've seduced the scientific founder into the jargon that's needed and the business stuff that's needed in order to be able to get that. And more importantly, they've got a third of the company, not a third of options. They've got a third of the company. And then you have to deal with that mess when inevitably one walks away, a second might walk away, and you've now got to bring in people who are actually going to need incentivizing equity-wise when most of the valuable equity has been given away, right? So I look for simple equity structures around there and management who respect that it's someone else's money. So
Right.
that comes into sort of the governance and alignment. It's not just about taking the money. The success isn't raising the money. It's how it's deployed within the right strategy, execution, governance framework, and people who commit to managing internal and external stakeholders with transparency and with honesty. We can all handle things go wrong. They go wrong in every business, even those great ones that I told you about. Arm came out of a failed business.
Yeah.
Right, it came out of a failed business. Abcam nearly went bust at some point, right? We all did. All the good companies have difficult periods around this. So the people who are investing in your companies know this.
Yeah.
So commit to be transparent around there, and then they'll help you go along when the difficult times inevitably come. So practical things like that, I think I weigh them very highly. I would rather drop a project with misaligned people who are not realistic about what they're going to have to do around there, because they won't make the tough decisions when they come. They won't report transparently around there. They'll report anecdotally. It'll always be going well. No one will know with clear objective. No one will have aligned, shareholders, board, executive, people through the company won't have been aligned to, we're all agreed that these are the key value drivers, and here's how we're going to measure them. Because it will just keep moving. It'll be like you're on sands that are shifting. So there are the key things, things that have certain characteristics and things. That's the type 1, type 2, and then particularly about the people.
Yeah, it makes sense. And it's interesting, isn't it? Sort of, we kind of touched on this earlier, but you mentioned those sort of near misses, right? Those near fatal moments that companies are going to have. So the people being in place to deal with that is critical. I guess there's an argument to say you almost need that near miss to instill then the discipline to make the company successful in some ways, right? Especially if it's your first time around. You got to see how bad it's going to get, or it could get, to be disciplined about this stuff.
Absolutely. Absolutely.
Yeah. And so that probably leads us on, what you've just been talking about, to mistakes that you see people making. I guess whether it's in terms of fundraising mistakes or, what are the things that you see out there that really trip company leaders up?
I'll talk about the fundraising because I think we covered quite a little bit before, right? On the people. I think the alignment piece is absolutely fundamental, right? But we won't repeat that. So if we look at, for example, when people go out raising funding, people are, you get a couple of things. You get people who are scared; they haven't done it before, so they do what's called a lot of analysis paralysis. They get analysis paralysis. They do a lot of work, and they don't pull the trigger. They don't get out there speaking to investors early enough and building confidence in the proposition, getting feedback on the proposition so that they can hone it. But one of the biggest mistakes is why one of the workshops I teach at various business schools and to entrepreneurs, etc., is about it's about communications, right? How you take complex information, distill it down to simple concepts and its essence, and have it and put it to people in a language that they understand and in a context that makes it relevant to them. That's really important in everything you do in life, whether you're pitching to investors, whether you're trying to get an key employee to join you through recruiting a senior executive who's got lots of other choices, for example. So how you get people aligned to a common purpose. If you're a leader, you're trying to align these different stakeholders. If you can't communicate the essence of an idea or a concept clearly, right, in a way that is, it's compelling, it's contextual, it's conversational. You're not beating people over the head with the idea, because that's about you rather than it being about them around there. That's really difficult. So when your people are pitching, I think this is one of the biggest problems that they have, right? So it's a failure to understand what the purpose of the pitch is. Maybe in the 90s, I've heard a few stories about Aurora Bioscience. I think it was Frank Craig and Harry Stiley. It was all based on Roger Shen's great work out of Stanford on GFP and beta-lactamase, and they founded a company called Aurora Bioscience that was funded by a consortium. And I understand that they pitched in a room to one of the pioneers, Avalon Ventures, and they actually raised money in the room.
Right. Okay.
Around there, right? The check wasn't in the room, but the commitment was made in the room in the first meeting. That doesn't happen. That just doesn't exist anymore. So people say, unless you're in that particular time of the wild west of biotech, understanding what the purpose of that pitch is really important. It's not to close a deal, but it's to educate the investor into the high level concepts of what you do, why it is important, to what groups of people it's important, how you create value out of that opportunity, and then very importantly, what is actually in it for the listener, the investor, in this instance, in a sort of really, clear, concise, compelling, contextual, conversational way. That's the sole purpose of that first meeting, is to make people want to engage with you further on the journey of building confidence in the process. So then they can start looking at the strategy, execution, and sort of governance plans, the people, etc. But they're taking that first step. So many people fail to do that. They're standing there and the presentation, the pitch is about them. It's about their interests, their vision around there, etc. And while those things are important, right, when you're speaking to someone for the first time about it, it's not what's important to the listener. They want to see how that vision and stuff might drive the group of founders and how they have a view of how the world will change. But initially, it's to put it into context, the opportunity to the listener. So I think that's a fundamental thing that people make a mistake, right? So it's really an opportunity to show, beyond that, as you go through that meeting, the first meeting, and then maybe a second meeting, it's an opportunity to deal with some of those alignment management issues that I just talked about previously, right? It's an opportunity that you understand beyond the vision, which may look to here's a mountain in the far off distance, but we don't yet know whether there's a whole range of other mountains between there. Is it a 5-year journey to get there? Is it a 10 or 15-year journey to get there, around there? And it might be a 15-year, 20-year journey to get there, but you've chosen a company as the vehicle for getting there that refinances every 2 years and has to cycle through investors, the 4 to 7 year time window, and then beyond that, scale up capital, etc. So it's to show, in the outside of the great science, well positioned with great founders who have a vision beyond that, is to start getting to that level of building confidence, which is understanding that you are an aligned group of realistic people who understand strategy. Where are we going to play with this technology or product or service? What are the tactics that we can deploy? How are we going to win against different types of incumbents? And how are we going to organize ourselves to be able to win? That strategy, right, at the end of the day. And then understanding that there may be different routes up the mountain. That's your business plan, right? There's many different routes up the mountain. They all have different risks and reward profiles. And if you understand the different risk and reward profiles, and you can communicate that you've looked at those different things, and here is why we're deciding to go up this route. But then there comes the governance piece. We're not just going to run up there. We're going to see, well, these are the key. We agreed, we understand why we're going this route, but there are other routes we could take. What are the points at which we review whether we're on the right path or whether we need to adjust path? That's your governance, right? Your key performance indicators, reporting, various things like that. So it's a chance if you're a communicator, as leader of your company, because you'll stand out much more so than if you're standing out about adjectives everywhere. It's super duper, this technology. It's unique. It's everything. It's everything. But what about us? What about us? Get them excited by clearly understanding the vision and how it's going to how you're going to translate to meet the opportunity of that vision. But then it's about, we're a group of people who are actually aligned that we're going to do whatever it takes in order to be able to get there, right? And we're going to bring everyone along with us to this journey. But make no mistakes, we want to reach, if it's a 15 years. So the capital is not going to define the journey. So we're not going to be happy to raise money. We're going to raise the right money at the right time on the right terms, but we're going to respect that when it comes in around there, and you're going to get the Ferrari of treatment as investors, which isn't just kissing your ass, right? It's about everyone being bought into the decisions we're making, reporting relentlessly against those decisions, so that we can then make adjustments in the plan that everyone is bought into, so everyone can't sit there when things are going wrong saying, well, we weren't consulted, etc. So there's that. And that's that sales process that we just talked about, right? Once you've got everyone bought into that first piece, it's about building sales. The due diligence stuff, the science typically works out, things typically work out. But ultimately, if it looks like it's an unrealistic group of people, it brings the biggest pause of thought to most investors. And if you look at bad founders and management, they're long on vision and strategy, they're poor on execution, and have no respect at all for governance. I've invested in companies where the only time you hear from them again is when you get a letter through if they want to raise more money. That's only very few, but you do have them. And then the good companies that do get support through tough times are the ones who do the former.
Yeah. And it's interesting, isn't it? I think people like to think of fundraising as different to sales, but it's selling, right?
Of course it
That's what it
is.
is.
Yes,
Yeah.
absolutely.
And what you're talking about here is kind of if I'm running a sales training program at the moment, actually, so this is right in my
Yeah,
head. Why should you care, and why should they care, and why should they trust you as a team to do it?
absolutely.
Yeah,
Well, you create ultimately what you're doing when you get people to sign up to your company and your plan and various things like that is you're creating a sales covenant.
yeah,
Right, that's essentially what you're doing, right? And the covenant comprises just the details of the plan, but it comes across an understanding and empathy of each other's positions and how you're coming from things and how you're going to keep those alignments as you go through the process, right? So it is a sales covenant, and people will only sign up to those once they've built the confidence of going through the process of
yeah,
buying into the idea at the high level, the diligence on all the key fundamentals, and particularly the diligence on the people. And when let's be honest, the greed overcomes the fear, then people are going to make that decision. But it's a
yeah,
confidence building process. You know, in your industry, right? No one just turns up and says, they might, if we've worked with you 3 times before, and had good results. You've built your
yeah.
brand. You built your brand, and you've had your covenant with that. We'll come back, and it'll be a relatively low bar to do resale. But if it's a
Yes.
new time, you know what it's like trying to get new people on board, right? It's a
Yeah.
totally different gig.
No, absolutely. And Darrin, you've already shared lots of advice and insight here, so I think this will be really helpful for people listening. But any, as they head out into the dark night of this current market,
Yeah.
any final pieces of advice or thoughts that you'd want to leave people with?
Yeah. Okay. So what I would say is that, we've talked about some of it here. When you're presenting your vision around there, and you've got to make sure that that's a compelling vision. People need to
Mm,
believe that it will both drive the team on a day-to-day basis, so that they're going to go through walls to deliver on this idea
right.
around there, and it's exciting enough opportunity that investors have the potential for something that's going to scale in the future, right?
Yes.
Then that it's a practical team, that are going to sort of focus on what's important in terms of proving validation of technology, of market, etc. But there are some very, I think, practical things that's specific to this market.
Mm-hmm.
Even if you have a big vision based on a platform that could disrupt multiple different markets, for example, start now, present the opportunity, but narrow the scope. It might mean phasing how you might develop a pipeline, for example,
Right.
or how you develop a product or a service derived from the product. And so we're showing that we're going to focus on what's important in this first period, for example, but while still having these opportunities in the can to
Yes.
scale later. And that your plan is really well thought out, that it is capitally efficient. And that's really important right now,
Mm-hmm.
that people aren't seeing that they're throwing loads of money at things that aren't driven towards the key value inflections in the early stage.
Right.
Because think of it, every investor is worried about who's going to be the next investor
Right. Of course. Yeah.
around in there, or the next buyer of the product, etc. Right there. So have some empathy with that around there,
Yes.
right? So plans are not getting funded that are going to lead to overcapitalized companies right now. So make sure that you're there. But that doesn't mean the opportunity isn't there. This is where founders need
Mm-hmm.
to get realistic. Every stage of most of the companies I've been involved, particularly the ones that have been successful, everyone was unhappy at different points. We're over diluted. We're this, we're that. We're not doing this. We're not able to do that. And look at how much we did. Right?
Yes.
So you have more time than you think, and you don't need to be as intransigent that it's my way or the highway around every single thing that you want to do on day one, right? So
Mm-hmm.
be focused, practical, take that plan. It's got to be proactive, narrow in scope, clear objective milestones of how you're going to create value, and then it can be built upon in subsequent funding rounds when you now have a track record of actually delivery.
Yes.
Right, that was the key with Horizon. Very little money raised early on, and you did so much with that little money that everyone wanted to invest at higher
Mm-hmm.
valuations. Therefore, you had choice whether you took the money or not, or whether you did certain things. And then when you got to the capital markets, a company that had raised very little pre the IPO then was able to access $250 million in
Right.
the public markets. So you turned world-class science, but through commercial success, you then earned the right to have the opportunity to do something, right?
Yeah. Yeah. Yeah.
Bad founders want to do it all on day one, and if you don't commit it to do it on day one, it's not going to work. So that's what not to do. Right? Be more
Yes.
practical, be more stepwise in how you're going to do it, but still keep your eye on what the big prize is. When you're speaking to investors, don't get concerned. Don't get into too much analysis paralysis. get out there first and do a readiness phase. Are we ready? Present the opportunity around there to a group of relative group of investors who are I've got the right word. It's not relative. A relevant group of investors. To the type of thing that you think you want. See how the opportunity goes down with them around there in terms of positioning, scope, team, etc. around there. Look at the capital structures that you have in place around there, the relationships with founders, all of these things that could be the red flags when you actually go out fundraising. So start doing it early through like you do an IPO. You do an IPO readiness phase, which starts with which markets are we going to be on? What's the growth proposition around there? What is it? Then you go and present it to some investors and you see whether you're in the right ballpark, etc. Of all these things. I would encourage people to get out that and do. Investors are still taking meetings all the time. And they don't, because you don't have to meet face to face all the time now. It's quite easy for them to get more meetings in the book. So I would do that, what I call a fishing exercise around there. And then, there's no substitute for building a buzz about your company. So because if you can get out there and people are starting to talk about, here's this company that's got a brand new modality in therapeutics. Yes, it's high risk, but it's high reward around there. They actually present really well. The plan's actually really practical and good, but it has real potential to scale in the future around there, right? And then there are examples, for example, where what new data comes out from another partner, another place in clinical around that program, right?
Yes.
And so all the time you're continuing to have dialogue with the investor community, even if you're not fundraising at any particular point in time, and you start to build a buzz around that company. Yeah. And as you deliver, make sure that people are kept up to speed with your delivery. And so when you're ready to go, you're in the front of people's minds. There's a buzz about it, and people are waiting to see you, rather than you're just one of 100 people writing in that day, hoping to be heard.
Yeah, and they feel almost like they're part of the journey already, right? Before they've even got involved.
Yes, absolutely. Awareness is classical sales. Awareness, engagement, customer segmentation, understand who your key stakeholders are, what's the best way to communicate to them, how do you bring them onto your side of the fence, which is the first step towards creating that covenant.
Thanks for listening. Outside of hosting podcasts, I'm the CEO of a company called Singular. We work with biotech businesses from seed to Series B to help them build a brilliant culture that delivers on their milestones. Come check us out at www.singular-biotech.com, and I'll see you next episode.